I'm Adrian Finnegan. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, recession, why an emergency Fed rate cut just isn't good enough to save the global economy from the impact of the fast-spreading coronavirus. As the World Bank offers billions to developing nations to support healthcare systems, we're inside a lab that's working to find a vaccine to fight the virus. And oil companies in the Republic of Congo have discovered vast oil reserves, but drilling could be environmentally damaging. The world's factory has been shuttered, supply chains have been broken, flights have been grounded, tourism decimated. That's the real-world consequence of the coronavirus, and the epidemic has yet to peak outside China. Growth could halve this year, warned the OECD, to 1.5% from its previous forecast of 2.9%. Growth below 2.5% indicates a global recession. As markets crashed, central banks stepped forward to say that they were ready to support growth. The Federal Reserve cut rates by 0.5 percentage point, its first emergency cut since the financial crisis in 2008. Now, whether central banks have the firepower after more than 700 rate cuts and trillions in bond buying after the financial crisis is another question. And after all that, it was the stock markets that benefited most from the rate cuts. Little trickled down into the real economy. And unlike the 2008 crisis, where banks needed a desperate infusion of cash after they lost a bet on subprime mortgages, this time they need governments to step forward to stimulate the economy. Case in point, governments may need to find money to bail out airlines. The industry stands to lose $113 billion in revenue. European regional airline Flybe, already in financial trouble, went into administration after bookings collapsed due to the virus. The IMF and World Bank say that they're ready to help poor countries where health systems are weakest, including providing emergency funding. The World Bank has pledged $12 billion and the IMF has set aside $50 billion. So we had that grim warning from the OECD that growth could shrink this quarter for the first time since 2008. Ratings agency Standard & Poor's believes $211 billion could be knocked off Asia-Pacific economies. And we've had grim economic data. China's factory activity slumped to a record low last month. Now, this is a supply-side shock. What exactly do we mean by that? Well, previous recessions have come about because consumers have stopped spending. This coming recession, though, is more like the oil shock of the early 1970s, when Middle East states cut off crude supplies, which means that companies don't have the labour or supplies to make goods. Just to illustrate that further, Al Jazeera's Jessica Washington reports now from Indonesia.
On the outskirts of Jakarta, this $6 billion project is one of China's so-called Belt and Road investments. Construction is on hold for now, pending a safety assessment, but the project is facing more serious concerns. The team is depleted. Workers who went back to China for the Lunar New Year can't return because of a ban on Chinese travellers. The Minister for Investment also says the supply of raw materials from China is disrupted.
The fast train service is supposed to start from early next year, but the coronavirus outbreak could put the brakes on the project and slow down construction. This is just one example of how the outbreak is derailing investment and disrupting supply chains, and countries all over the world are dealing with the fallout.
When SARS happened in 2003, the Chinese economy was only 9% of the global economy. Now it's 19%. And China's capital is very much needed and used globally.
Countries are feeling the strain in different ways. In Australia, international education is the country's third biggest export, but a travel ban has left thousands of Chinese students unable to return to university. It could cost the sector millions if they cancel enrolments. Thailand has lowered its growth outlook for the year as its economy suffers from the absence of Chinese tour groups. Italy's already sluggish economy will take a further hit, with a number of towns and manufacturing hubs in lockdown. And trillions of dollars has been wiped from US equities, pushing stock markets around the world into the red.
What we're also seeing is a disruption to supply chains. As companies have slowed down manufacturing in China, that has impacted other Asian and Pacific countries who've relied on those inputs into their manufacturing processes. No longer are we standalone countries. We operate in global supply chains, and that's what the coronavirus has really exposed.
Governments are looking for ways to ease the economic burden. Hong Kong announcing a stimulus package, a cash handout of around $1,200 to every adult. Indonesia's government, meanwhile, will provide massive discounts on hotels and flights for foreign and domestic travellers. Economists say measures like these are expensive but necessary.
This is the challenge that governments have. Consumers are scared. I suppose governments only have a few levers to pull in this case. One is providing confidence in their health system, and then the second is giving some stimulation to their spending by either discounting elements or lowering the cost of debt.
These are short-term band-aid solutions. Ultimately, there's only one way to improve the health of the world's economies: finding a cure to the virus.
Well, let's pull all of this together with our panel of experts. Joining us now from London, Bilal Hafeez, CEO of halve, and from Singapore, Rajiv Biswas via Skype. Rajiv is the Executive Director and Asia Pacific Chief Economist at IHS Markit. Gentlemen, welcome to you both. Bilal, let's start with you first. Are we heading for a global recession?
Well, I think the chances are very high that we are indeed heading for a global recession. At the very least, we could enter what's called a technical recession, where we have 2 quarters of negative growth. Whether we enter a deeper recession, where you see sharper increases in unemployment, is still harder to tell. But at the very least, there's a very high probability that we do indeed enter a technical recession.
Rajiv, would you agree with that? And what sort of recession are we talking about here? A supply-side recession?
Well, our base case is that world growth will be slowing down, but we still have growth in our base case of around 2% for the world economy. But clearly, the first quarter will be a very big negative impact on China, as well as many other Asia-Pacific economies. Whether we can then progress to the situation of a scenario of global recession really will depend on how much this epidemic spreads globally. Clearly now we have very substantial escalation in South Korea, Iran, and also Italy. So it's certainly a growing risk that we could see this escalating into a pandemic that affects the whole world economy, and that could destroy global consumption. And in that kind of scenarios, there is certainly a risk that it could evolve into a global recession. But at the moment, our view is still that world growth in the order of 2% is what we're going to have this year.
Bilal, do central banks have the firepower, the wherewithal to at least cushion any sort of recession? Interest rates are already about as low as they can go, aren't they?
No, that is indeed true. I mean, obviously, we've seen this past week, there's been coordinated central bank action from numerous central banks, notably the Fed. They cut rates by 50 basis points. Markets have responded, on balance, fairly favorably to that. So at the margin, it does seem like those actions are cushioning the blow somewhat. But as you rightly point out, there are a number of countries from Japan to the Eurozone, and indeed even the UK, where rates are very, very low already. So there's a limit to how much further they can indeed cut rates. But there's also something more fundamental, which is that this is actually a health issue where people obviously are catching the virus, it's spreading, there's an infection, there's a pandemic or possibility of a pandemic. And so there's only so much a central bank can actually do to mitigate that. What's needed more is a health response and a mitigation policy to soften the spread of the virus and also to limit casualties from it.
Rajiv, what do you make of the Fed's emergency rate cut?
Well, clearly, they were trying to take action to be a bit preemptive on expectations that the spreading epidemic would affect the U.S. economy. And certainly our surveys of U.S. manufacturing and also services for the month of February do indicate that already U.S. companies are starting to feel the impact of weaker demand coming out of Asia in particular. Of course, China is an important market for revenues for many U.S. multinationals. So I think part of that, plus what we've seen in financial markets with a lot of selling in recent weeks, have all kind of come together to get the Fed to be more preemptive in their action. And I think that's why they moved between their scheduled meetings. And I think that also, of course, spooked markets, that markets became worried that the Fed's seeing a big shock coming out for the US economy. And that actually perhaps was a little bit of a counterproductive action. But we would expect the Fed to move more, and we would also expect many other central banks to also take further action. We've seen a lot of Asian central banks and the Australian central bank already moving, and there'll be a lot more easing, certainly in Asian countries, which are at the forefront of a lot of the economic damage up to now. And there will be a lot of financial stresses on companies that are in the forefront of all of this, particularly in China, now in South Korea. Small to medium enterprises are going to face a lot of financial stresses in the coming weeks ahead. So central bank action is one of the important tools to try to pump more liquidity into the financial system, and also to the extent that's possible, to lower borrowing costs for these companies.
Bailout, President Trump made it quite clear he thought that the Fed's 0.5% rate cut wasn't enough and that they should be doing more. What more does he mean?
Well, I think President Trump has a big focus on the performance of the S&P 500 and stocks in general. He often tweets about the level of the stock market. And so I think that what Trump wants is the Fed to do whatever it takes to ensure that the S&P 500 remains at high levels. So after the cuts by the Fed earlier this week, the initial response of stocks were to fall, and President Trump then responded to say they should do more. As it happens, a few days later, stocks have actually rebounded much more strongly. And so my sense is that President Trump's view is for them to cut rates whenever there is a large correction.
Rajiv, ultra-loose monetary policies since the 2008 financial crisis boosted asset and stock prices, as we were just saying. That's failed, though, to generate substantial rebounds in economic growth. Is it fair to say that rate cuts will be less effective to combat any economic pain caused by a health emergency?
I think in general terms that's true, because the nature of the shock is quite different to a traditional economic downturn, because what we're seeing here is panic amongst households. They don't want to go out in countries like China and South Korea. What we're seeing is people want to stay at home, only order online, and therefore they're not going to do a lot of the normal shopping and purchases that they would do, such as buying cars, buying durable goods like electronic items. They'll just buy household essentials and try to order it online. So that very much results in a contraction in consumer spending. And I think that is the big difference, where government action, whatever they do on monetary stimulus or fiscal stimulus, it's hard to force the consumer to spend in this kind of situation. And I think that is the fundamental difference, and why easing monetary policy has significant limitations in this situation.
Bailout, let's talk about some countries, some specific countries here. You mentioned Italy, which of course has been one of the hardest countries hit by the coronavirus. It says it plans to spend 3.6 billion euros in stimulating the economy. That sounds a lot, but given the size of the economy, it's not really. Italy's economy had contracted in the last quarter. What more should the government be doing? Is Italy headed for recession?
Well, first of all, I think that there's a very high chance that Italy is currently in a recession. It had negative growth in Q4 last year. This current quarter should see negative growth once again. And there's a good chance that Q2, the next quarter, should also see negative growth as well. And in terms of what the government can do, one is there should be a fiscal response. And we are starting to see that. There are some constraints for Italy. Of course, its overall debt levels are high. And so the European Union may be a bit more cautious around them expanding the fiscal balance too much. But the important thing on the fiscal side is that it has to be the right type of fiscal support. So the issue here is that there will be numerous companies that will lose revenue in the coming few months and quarters, and so they'll need support from the fiscal side or from the central bank. Also, there may be people who will be off from work as they're ill, and they may not necessarily get paid for prolonged periods of absence from work, so there needs to be support on that side as well. So the type of fiscal policy that is needed, it's not just about the size of the fiscal policy, it's also the type of fiscal policy that has to be specifically addressed to a health crisis.
And Rajiv, let's come back to Asia. South Korea putting, what, $10 billion in, 700 million plus in Indonesia. Singapore and Japan, though, are they headed towards recession?
I think Japan, which is the second largest economy in the Asia Pacific and one of the world's largest economies, is definitely facing the risk of entering recession in the first quarter. The fourth quarter of 2019 was already quite contractionary because of the impact of the consumption tax hike. And now in the first quarter, you not only have that negative impact still on the consumer from the consumption tax, but also you now have the negative shock from China's economic slowdown, weaker orders for Japanese manufacturing. So I think there is a real risk that Japan will enter technical recession in the first quarter of this year. And also for Singapore, I think for the 2020 year, there is a growing risk of recession. The impact of the Chinese epidemic back in beginning of February was very, very dramatic in Singapore because Chinese tourism is so important for the for Singapore's tourism industry. So that took a major blow immediately when Singapore government decided that visitors from China would be temporarily barred from entering. So that meant Chinese tourism collapsed overnight. And so I think, that has escalated the risk that when we look at the full year, it could be a year of recession for Singapore. And the government itself has acknowledged that that's a risk.
And back in Europe, Bilal, is Germany ready to provide any form of stimulus? It hasn't in the past, despite international calls and voices at home growing for it to do so. I mean, after all, German industry is in recession at the moment.
Yes, indeed. I mean, there's been an ongoing debate in Germany, within Germany and outside of Germany, that Germany should do something on the fiscal side. And I think this is the occasion where they will end up doing something. There are some challenges. There are certain rules they have within the constitution and within parliament that restricts how much fiscal stimulus they can do. However, there are caveats to that. In so-called kind of emergency situations, they can engage in fiscal stimulus. And there is indeed significant commentary amongst the ministers within Germany in recent days for them to enact some kind of fiscal stimulus. So my sense is that they will instigate some kind of fiscal stimulus, especially when the number of cases in Germany starts to increase, and it has indeed been increasing of late. Germany in particular, not only does it suffer from the slowdown in China, it also suffers if the rest of Europe is slowing down, including Italy. So in many ways, Germany is at the forefront, or is at crossroads of all the negative forces that are coming out from this health crisis. And so I think in the end, there will be some fiscal stimulus. However, the response will be slower than most of the countries around the world, mainly because of the general reluctance for the Germans to run fiscal deficits.
Gentlemen, Bilal Hafeez, Rajiv Biswas, many thanks indeed for helping us draw all of that together. Really good to talk to you. Thanks for being with us on Counting the Cost.
Thank you.
Thanks very much.
Now, the United States has pledged $3 billion in emergency funding to develop a vaccine for COVID-19. Government agencies, universities, and around a dozen private companies are involved in the race to find a vaccine. Al Jazeera's Heidi Jo Castro has visited a lab in Maryland where researchers say they're making some progress.
The potential answer to stopping the coronavirus may be swishing around inside these trays. Researchers at the U.S. vaccine company Novavax say they have made a protein that stops the virus from binding to human cells.
We are working countless hours, and I think we have made a significant progress in last couple of weeks.
Scientists here received the coronavirus gene sequence on January 10th. They say within weeks, they'd cloned a non-infectious element of the virus, using ovary cells from a North American caterpillar as a protein factory.
So now we have insect ovary cells making a spike protein, which we then purify, and that becomes a vaccine.
The Novavax procedure has worked to make vaccines for the flu, Ebola, and MERS. For the coronavirus, it appears to be effective as well. Clinical tests are expected to begin this spring. Though full licensing takes years, vulnerable communities could receive the experimental vaccine on a compassionate use basis much sooner.
The incentive is to save and help people as quickly and as soon as possible.
In the race to contain the coronavirus, a win for the first to cross the finish line with a vaccine or a treatment is a win for all. And so government researchers here at the National Institutes of Health are partnering with private labs to quicken the pace of drug development. Moderna is another U.S. biofirm making progress. Its coronavirus vaccine is already in the NIH's hands and preparing for clinical trials in April.
I think that's commendable. If we have to come up with 1 billion doses, you might actually need, several vaccines that are working.
The coronavirus has killed thousands and is heading toward a pandemic. U.S. health officials say this is the fastest science has ever moved to develop a vaccine, but it could still be more than a year before any is massively deployed.
Now, oil companies in the Democratic Republic of Congo have discovered vast oil reserves, but they're below 10,000-year-old peatlands and next to the Congo rainforest. Environmentalists say that drilling for the oil would release tons of carbon that's stored in the peat. Al Jazeera's Malcolm Webb reports now from the Democratic Republic of Congo's capital, Brazzaville.
Beneath this swampy forest lies carbon equivalent to about 20 years of emissions from fossil fuels in the US. It's stored in peatlands that scientists discovered here in the Republic of Congo 3 years ago. The government didn't allow us to go there and film. This is the government's video, but it did allow oil companies to drill there last year. It's licensed oil exploration in blocks of land across more than half of the peatlands. And environmentalists say if oil's extracted, it risks releasing 30 billion tons of carbon stored in the peat.
It will be catastrophic. Even if we try to exploit the oil in an eco-friendly way, we still have to destroy the ecosystem to build roads to transport the oil. It will make this area more accessible for the exploitation of other resources and also endanger its rare wildlife.
The River Congo is the world's second largest river by volume, and the rainforest that sits in its basin is the world's second largest after the Amazon. And its leaves and branches falling from the trees, partially decomposing in the ground, that have formed the peatlands over about 10,000 years. They've been discovered on both sides of the river in swampy areas, and the carbon stored in them beneath the ground is as much as is stored above the ground in the entire forest. The Congolese government signed an agreement to receive $65 million of funding from European governments to preserve the peatlands and the forests above them. But activists say the agreement doesn't rule out oil extraction. The country's Africa's third largest oil producer. 2 oil companies announced major onshore oil discoveries near the peatlands last year. But the Environment Minister told us the peatlands are safe.
What we are saying to the international community is that the Congolese government will not touch the peatlands if we ever find oil there. Even if we have to do it, if we find petrol in the peatland areas, we will do our best to do a good job.
The peatlands are also home to millions of people. The government says oil revenues help communities. Environmental activists say they don't. And that if oil extraction goes ahead here, the world's largest tropical peatland and its vast carbon reservoir will be gone forever. Malcolm Webb, Al Jazeera, Republic of Congo.
And that's our show for this week. If you'd like to comment on anything that you've seen, you can get in touch with us by tweeting me I'm at A. Finnegan on Twitter. Please use the hashtag AJCTC when you do, or you can drop us a line. countingthecost@aljazeera.net is our email address. As always, there's plenty more for you online at aljazeera.com/CTC. That takes you straight to our page, and there you'll find individual reports, links, even entire episodes for you to catch up on. But that's it for this edition of Counting the Cost. I'm Adrian Finnegan from the whole team here in Doha. Thanks for being with us. The news on Al Jazeera is next.